Hey traders, this is Blake Morrow with Trader Summit. And once again, I have Mr. Dave Keller, CMT. How are you? Good to see you.
You too, Blake. Doing well. Good to see you too.
Yeah, it's always a pleasure seeing you. And you have one of those faces when I see it and I see your smile, it always makes me smile. No matter how bad I'm feeling, I'm like, hey, he's a cool guy. So, but today is kind of a unique day since it's the day before the Fed. We've got stocks that continue to rally. We're at all-time highs once again. Last time you and I spoke, you said, hey, the market looks a little stretched. You weren't really too sure about the strength, but here we are, a month and some change later. Stocks are still holding up really well at all-time highs. Has your views changed at all, especially with the Fed coming tomorrow? And, I guess we could probably talk a little bit of what the market expects, but fact of the matter is stocks are still at all-time highs. So what do you think here?
I was going to say, and then I think what I learned is the best indication of what the market is thinking is by focusing on the charts, right? Focusing on the price. The price will tell you what people are expecting. It can tell you when people are euphoric, desperate, excited, nervous. All of that's reflected in the price, right?
Yeah.
And so I would say, if what has changed since we spoke last, it's certainly a renewed strength in the major averages. So when we spoke last, it was sort of in no man's land of sorts, right? You're sort of coming off of new all-time highs, but then we're sort of in this choppy period. Now you've seen the S&P, the NASDAQ, the Dow Industrials, Dow Transports, all making new highs in the last week or two. And that really represents renewed strength overall. What I would go back to is I'm sure what we talked about before, which is I think depending on what you own in your portfolio, your experience as an investor has probably been very different. So if you've owned the small cap index for the last 6 to 8 months versus the FANG stocks, right? Your experience has been totally different.
Sure.
And so I think even just looking at the 6 FANG stocks, some of those are making new all-time highs. Some of them are actually not. They're actually looking relatively weak and they're probably not great technical patterns. So I think now more than ever, it's not a time to just own the S&P and go to the beach for a while or whatever you want to do. It's really to focus tactically on where the opportunities are, because I think some charts certainly look better. They differentiate themselves looking better than others.
I have to maybe throw the old cliche out there that 2021 is becoming more of a stock picker's market. And I'm going to venture to guess that that's probably going to be the case moving forward for probably some years, I'm assuming, right?
I think you're right. And again, I think this year is a perfect illustration of that. And whether you look at, global stocks, if you've owned, emerging markets in 2021, you're actually down on the year, probably 1 or 2% versus the S&P where you're up 20+%. And so I think there's quite a differentiation in cap tiers, in styles. Look at small cap value up a ton versus small cap growth, which is up maybe 10% versus 30%. So I mean, there's a lot of opportunities, I think, and again, I'm very biased to the technical approach, but if you're able to identify trends and lean into what's working, I think you have an opportunity to do better than just sort of a passive, just let it rest type of approach.
Awesome. Well, I want to take a look at some of the charts that you're looking at, but I also have to mention that, you mentioned the Russell 2000, and it is making all-time highs today, but at the same time, I look at the chart and we're really at levels that we saw back in June or May, June, and we saw them back in March. So it's like, I hate to get super excited right now as we're up against really key resistance, but as you pointed out, there's a lot of things underneath the surface that are starting to look better than they did the last time that you and I spoke. So let's see what you're looking at.
So we're looking at the Russell 2000 ETF, and I think you're right? Depending on where you're looking, I think the market means something very different. And you had mentioned it's a stock picker's market. I always describe it's not a stock market; it's a market of stocks, and focus on the underlying names that are creating these patterns. The S&P and the NASDAQ are an aggregate of a bunch of individual stocks, and I think there are themes at work there. This is the Russell 2000 ETF. It's essentially been unchanged, right, since March. You made a new all-time high in March, and we're just now once again trying to eclipse those levels. And it tried in June and July. Now, this is as the S&P and the NASDAQ are making successively higher highs every month. The Russell 2000 has been unable to do so. And while it is certainly encouraging, it's testing new all-time highs. Absolutely. If the Russell 2000 goes up from here, I think it's absolutely worth having exposure there, it's worth noting that it's still lagging behind in a big way behind the large cap indexes.
But I noticed it's really holding your 200-day moving average. I believe that's your moving average that's in red. And could we expect, and I'm going to ask from your technical prowess, you see a big range that it's been in 2021. Would we simply get if it did break out, get maybe a range extension of what you're seeing right there?
Absolutely. And it's sort of one of the basic tenets of technical analysis is looking at the range of patterns, right? Because the market has a memory, right? There's a certain dynamic, there's a volatility to different price behavior, given the asset class, given the index. And so, Russell 2000 ETF has been fluctuating in this point, probably in this range, about a 25-point range from low to high 2021. And one of the basic premises is if you finally get a confirmed break above that upper end, two things to keep in mind. The way you manage risk is by using that breakout level as your stop right at the beginning, right? Which means you make new all-time highs, you lock in those gains, and anything above there is positive. So one of the basic ideas of managing risk reward is making sure you lock in those gains once you make new highs. The second thing is where we go from there is taking the height of that pattern, which means there's plenty of upside here. I mean, that's actually a pretty decent, it's a 10% plus move if you get a continued move above there. And I think a lot of charts like this measure a lot higher. Maybe Tesla is the most outrageous example of that, blowing out, achieving those targets very quickly. But that's certainly what the charts are suggesting here.
All right, very good. And so you also talked a little bit about breadth. What else are you seeing in the markets that might be catching your attention at this point?
Yeah, so when you think about market breadth, this is one of the charts I like to look at. It's breadth by cap tiers, and it's important because again, I think a lot of times people oversimplify, and when they think equities, they think the S&P 500 or whatever that thing is, and that's fine if you want to be super simple. And for a lot of people that don't have the energy or the attention to focus on their portfolios, like that's probably okay and better than nothing. But if you really want to differentiate what you're doing, if you really want to identify opportunities, you have to look a little deeper. And I think that's where breadth indicators can be helpful. It tells you about participation. The index is doing one thing, the index is making new highs. What are these breadth measures doing? And so this is the cumulative advanced decline line for the New York Stock Exchange, for the S&P 500, so large caps, then the S&P mid cap index, the S&P small cap index. So going down the list of these three bottom panels, we're seeing large cap, mid cap, small cap. And if you look, the large cap AD line well above the highs there from June. This is June into July when all of these are sort of, making a new high. Yeah. If you look at the mid cap advanced decline line, just starting to break above its own June high. If you look at the small cap AD line, still well below its June high. And that's sort of that dispersion or that differentiation between those three, right? It's been large and then mid and then small, looking at the breadth conditions. Now, the way that this becomes more and more positive is these breadth lines rotate higher. The mid cap breadth line this week, barring some big give back through the remainder of this week, which is certainly possible, but overall appears to be making a new high and making a new all-time high for the year, which is encouraging. The small cap index not doing it yet. So again, it's a reminder that depending on what you own, the experience has been one versus the other. And I think to be truly constructive about the market between now and year end and into next year, you'd really want to see the small cap breadth improve, because that shows you that things like financials and others that have really not been performing as well on a relative basis are really starting to participate. And that speaks to strength in the economic conditions.
Well, that's a really great look. And that makes a lot of sense where you talked about, well, this is how your experience as an investor, especially some of your long-term holdings, could look a lot different than maybe your neighbor that owns, a similar amount in the markets. So as far as the indexes go, what indexes are really standing out to you that maybe, let's just say, look the best and look the most favorable for further upside?
So I think a couple things you want to keep in mind. If we look at the S&P 500 chart, I mean, it's hard to argue from a technical perspective that it's anything but fairly constructive. We can come back to that in a second. But I think the most important chart you probably want to follow is the 10-year yield. Especially given the Fed meeting this week, that whole idea of transitory inflation, that's just sort of a temporary thing. The evidence certainly doesn't seem to be backing that up. And I think investors more and more are going to be grappling with that going into next year. Anecdotally, my wife mentioned elevated gas prices around us in the Pacific Northwest. That is my sort of anecdotal evidence that it's recognizable. My wife, who is not a financial person and rarely fills up the gas tank, notices that's a phenomenon. Yeah. But you're seeing that. You're seeing that with commodity prices going higher, right? Crude oil prices, the commodity index is going up. interest rates overall remain fairly elevated. And I think if you're looking at what to own between now and year end, this is the chart I would be looking at, because if this chart continues to remain high, continues to go up, this tells you that it's things like financials, which have really not been performing that well on a relative basis, certainly have an opportunity. Things like industrials and materials, which have been struggling a little bit. It's sort of the renewal of the value trade. If you see that line go down, though, it tells you things like technology are going to be where you really want to be leaning into. So arguably, this is the most important chart besides the S&P.
That's interesting that you bring that up, and you're looking at the yield. And I've talked to a lot of people that really fear higher yields, and they feel that a breakout in yields is really going to have a negative impact on the broader markets. Do you have any thoughts there? And I know you obviously like to lean more technical based, but do you have an opinion there?
It's one of those things where higher rates are sort of good until they're not, if that's a way to put it, right? I mean, the rates going up, to a degree actually show strength. I mean, that's actually what should be happening. If the economy is growing, rates should be able to go up. The yield curve should be able to steepen, and that should all be representing the fact that conditions are good. But when it hits a certain point, all of a sudden you start to worry about the negative impact of some of those things. And so can yields go, to 175, which is where we hit a peak in March? Absolutely. Could they go to 2%? Could they go to 2.25%? They could. That's all possible. I would think if we get to 2% plus, then people are going to start to be really concerned about the negative impact of those sorts of things. But what I'm always wondering as an investor is, what are those themes that people are underexposed to or underprepared for? And I would say most investors, myself included, have not been investing in a period where interest rates have been rising for any sort of, longer time period. And we're not used to a bank outperforming a big tech company just because the environment's not been like that. I think that is a theme a lot of people will be underweighted for. And I think there could be some opportunity there, particularly if rates continue to go up.
Oh, that's going to be the perfect reason for me to be following Dave Keller, chief market strategist at stockcharts.com. That'll be number one reason. But, and I know you love to talk charts, and I love to talk charts with you, but I do want to ask you an opinion about tomorrow, or about the Fed meeting that's coming up. You and I are both old enough to remember the Greenspan days, and remember a lot of the surprises. Bernanke, Yellen, Powell, Fed has been very telegraphed in what they do. So it's these little nuances and things that they do. In tomorrow's case, would be maybe a more aggressive or maybe less aggressive taper. But we all know a taper is coming. Do you have any opinion on how you think the Fed is going to react going into tomorrow? And I know this might be a little out of your wheelhouse, but I needed to throw it out there anyway.
No, you have to be on top of these things. And I mean, if you ask me as a technical analyst, the number of things that I've been asked to learn about in the course of understanding the markets, this is one of the easier ones. I mean, I'm thinking about geopolitics and, events in China and regulatory issues. But I think to navigate these markets, you have to be globally minded. You have to think big picture about how all these different things are related. There are a lot of variables at work. So you have to think about, I think you hit on it, which is they've, in a lot of ways, telegraphed this move. I don't think anyone should be surprised by talk about tapering. They've done a really good job of talking about it for quite a while. And I think at some point you want to see some specifics. And I think people are going to be, a lot of investors certainly are looking for a little more detailed information about how this is actually going to play out. And there's a lot of speculation about when a rate hike would actually be and when that would start to play out. Seems like it's down the road quite a bit. So I think that is sort of what people are pricing in. In general, with the Fed, what I've learned is it's all about whether something's different than expectations. I think people are expecting tapering. They're expecting it to happen going into next year. And I think if we hear anything other than that, there could be a bit of a surprise. I think the biggest challenge for that is, even though they've telegraphed it, a big reason why the market continues to go higher, and while you can talk about the S&P being overvalued, but it keeps going up, is because of all the liquidity that's being put in the system. When that stops, regardless of whether people expect it, it's certainly going to change the dynamics of the markets. And I think people might be surprised by how tapering is going to be less of a or more of a headwind maybe than they might be expecting.
All right. Well, Dave, I just want to mention once again, this is Dave Keller, CMT, also the chief market strategist at stockcharts.com. But Dave, how do I find out more about you other than just knowing your title?
Sure. Yeah, at stockcharts.com, and our goal is to empower investors to make better decisions. And this conversation that we've had, for me, I'm of course very biased to the charts, but I think charts give a great way to illustrate and present the facts of what has actually happened and help you understand things like the Fed meeting and earnings and how that relates to the market, to market history. So stockcharts.com is a great place to look me up. I'm also on YouTube. My channel is called Market Misbehavior, and check me out there. We talk a lot about the interreaction or interplay between behavioral psychology and investing using charts.
Well, price does not lie, does it?
Well said. Well said.
All right. Well, Dave, and by the way, if you guys are listening at home and you like what Dave does, you can also click on his link in his bio down below. It'll take you to where Dave's at. Also, if you like these videos, make sure you click the thumbs up and tell Dave that you really like this video, you like seeing more of him, and also subscribe to our channel. I think a lot of people don't realize on YouTube, it doesn't cost anything to subscribe to a channel. So this way you get to hear all the Trader Summit content that comes from us. So make sure you subscribe to our channel. Dave, I want to thank you so much. And I want to wish you good luck tomorrow on the Fed at the FOMC. And thanks for joining us. I look forward to our next conversation.
Sounds good. Look forward to it, Blake. Take care.
All right, you too. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.